Okay, thanks a lot for having the paper in the program. I think it's somewhat related, or more than somewhat related to the paper that you just presented. So this is sort of a joint work with Sumit Agarwal, Andrea Silva, and Carlo Wix at the Federal Reserve Board submitted in the US. So let's jump into the paper. So the motivation is relatively straightforward, and again, not too different from what we have just heard. We know that the individual makes financial mistakes when using financial products. This is a large literature and many sort of pieces of household consumer finance, especially in the case of credit card, which is what we care about in this paper. There is literature showing that credit cards tend to induce over-indebtedness and suboptimal repayment behavior. On the other hand of the market, let's say banks can design financial products exactly to exploit these financial mistakes, and so provide, for instance, silent and front-loaded benefits combined with shrouded and back-loaded costs. And so in this case, can take advantage of the fact that people make financial mistakes. You put the two things together, and there is literature showing that there could be a redistribution from naive to sophisticated borrowers. And the example of the mortgage market is one, but again, it's come out in the discussion early on. Like the intuition is the Gebelemson paper. So what we do in this paper here? So most of the literature, with few exceptions, is basically on sort of on the theory basis, and sort of they try to examine the distribution from naive to sophisticated consumers in an empirical setting is generally very difficult. One can do it in a structural way, but other ways of looking at the data is difficult because financial decision making generally depends on variables which are very hard to measure. And then we define very sort of granular and detailed data if you want to quantify benefits and costs of usage and use of financial products, and then estimate the costs. So what we do in this paper, differently from the previous one, we don't do a structural analysis, but basically we look at the credit card reward as a sort of an ideal setting to study this redistribution. And we do three sort of exercises. Like large chunk of the paper, we look at the problem from the consumer perspective. And so we try to ask the question of if there is a redistribution in consumer credit market induced by the rewards program on credit cards. Then we clearly want to say who are the people who benefit from that and who are the ones who sort of pay for that. And then we want to sort of try to go a little bit more deeper into the mechanism and say something about which kind of suboptimal behavior can explain these effects. And so basically we want to sort of say more about who are the ones who gain and who are the ones who lose. Then we sort of switch the problem on the other side of the market, and we look at the bank perspective. And here we want to see if a bank actually design exactly financial products, and in this case, credit card reward and non-reward credit cards, in a way to incentivize adoption and use of reward credit cards. And then we also look at how the bank profit from these different kind of products, and where are the sources of profits for the bank. And finally, we sort of, want to put a sort of, once we have put like a quantity sort of dollar amount of this sort of redistribution, we want to say something about sort of this redistribution in a spatial term. So we aggregate up everything across geographies in the US, and we want to see if sort of this distribution across consumers, it could be a mechanism that further sort of exacerbate existing income disparities. So these slides, I guess, is probably not very useful in this kind of context, but just to give you like a sort of very quick overview on credit reward program. So what we have in our data are the credit cards, and we consider reward credit cards the one that provides you like cashback, miles, and points, and everything is quantified in US dollar amount. So everything, any reward which is not quantifiable in a sort of dollar amount, it's not in our data. So for instance, like status, access to lounges, it's not. Any point which can be translated in a dollar amount is okay. To some extent, it's not a big issue because if anything, we're sort of underestimating the reward because there are non-pecuniary rewards that count as credit cards. Reward programs are very much diffused in the US, but more generally in Anglo-Saxon market, but they are sort of more and more growing in other markets as well, like continental and Southern Europe, Latin America, and so on and so forth. So clearly it's a paper on the US, but this is sort of kind of generalizable to many other settings. In the US, the market is big, like 75% of your consumers use credit cards, and reward cards account for about 60% of new card origination. And it's It's a big market because the largest US bank paid out like 35 billion in rewards again in 2019. It's more or less the size of the entertainment market industry in the US. So it's a very big market. So from a consumer perspective, which is basically what we analyze here, we care about net rewards. So how much money you get using the reward credit cards on net. So you have the rewards, which is basically the cashback, the points, and the miles, minus how much you pay using a reward credit card, which is interest paid and total fees. Okay, interest paid if you carry over a balance or you have a revolver, and total fees by a lot of all possible fees that you pay on the cards. And so we are interested in these net rewards here, and we are interested in how this variable here is distributed across the possible set of consumers.
Just to clarify my question.
Sure.
In many countries, not some countries, the credit card also provides information to the company which offers related products, and that might affect the interest paid and total fees. That's a surprising thing in non-US settings. So, in some sense, that might be an endogeny.
Yes.
Over time.
Yes, or yeah, that's an issue that could be that there are a few limitations. That's one. The other one is that we are not. So basically, what we study, we look at borrowers. We have multiple cards within a bank, and for instance, I don't know if you have like a card of Chase and a card of another bank. Then it could be the same similar sort of spillover effect across products, and that's a limitation that we have. And then yours is what you're saying is another sort of similar limitation in which you don't see spillover that could come like from using other products and maybe overspending in other ways. So the data are sourced from the Y14M data from the Federal Reserve Board, which cover banks with more than 100 billion assets, or the largest US banks. All the banks are there, all the largest credit card originators are in our sample. We cover 70% of outstanding balances on consumer credit cards. So basically, if you aggregate up all our data with what the Consumer Protection Bureau put as official numbers, we match 70% of the market. The data from Y14 are at the monthly level, at the account level. We have a lot of information. First of all, on accumulated rewards, which is exactly what we need for our analysis, interest and fee payments, spending, unpaid balances, credit limits, FICO scores, consumer income, which is clearly self-reported, so there is some limitation. I guess it will come up a lot during the presentation. We know zip codes, where the people are, and a lot of other variables, cardholder and card specific. What we do, we basically focus on a cross-section. So we have about 240 million credit cards in the US on March 2019. March 2019 is sort of a random month, pre-COVID, no Christmas, no Thanksgiving, nothing like that. It takes a lot to do what we do. At some point, we want to sort of basically run everything through over 12 months and see what happens. But for now, March is a sort of a quiet month to look at the data. So the first exercise, as I said, we look at the consumer perspective. And so what we care about is looking at sort of the distribution of net rewards. So net rewards would be a function of having or not a reward card versus a non-reward card, interacted by the FICO score. So basically what we do, we look at the distribution, sort of the distribution of net rewards along the FICO score. And then we control for cardholder characteristics, card characteristics, and a very sort of set of granular fixed effect. We do a lot of robustness here. In the baseline, what we have is this interaction of the FICO and income percentile, zip code, and bank fixed effect. So basically, we can compare two people which are in the same percentile of the FICO score, in the same income percentile, living in the same neighborhood in the US, have a classic and a reward card at the same bank, and we should be looking at difference in net rewards between these two guys, controlling for a bunch of other stuff. We do that, so we care about the distribution of rewards across the FICO score. In the regression that I show you, for sort of simplicity, we cluster the FICOs, the individual, the cardholders, in 4 buckets. So we have subprime guys, the near prime guys, the prime and the super primes. then I see a picture in which I show you the results basically work through the entire distribution. It's not an artifact of how we choose the buckets here, the FICO distribution. But this, again, is relatively straightforward. The FICO clearly is endogenous, is driven by consumer behavior and so on and so forth. So this is predated by a year in March 2018.
Quick question. Is it only the cross-sectional data? You don't have any time series?
Then when we look at, we have, in theory, we have on the time series. I'll show you when we look at the financial mistakes. We want to show that reward card induced over borrowing. In that case, we do it different. We exploit 1 year of data. But so far, it's just a cross-section.
Just a clarification. So you said people have different cards in the same bank? I mean, people have different cards in the same bank?
Yeah, many. Yeah. Oh, you can have different Chase banks, and different Chase cards, different, Yeah.
Some of them, okay.
Yeah.
So why is that? Sorry, because it's so different.
I don't know. I'm not. I don't, for instance. But my co-author has a main lot, and just yesterday, I talked with a colleague of mine. He basically opened up like a huge amount of cards, and attached exactly to maximize benefits and rewards. Sorry?
They are attached to the same bank account.
Yes. No,
Not necessarily.
not necessarily the same bank account.
So the same bank, but not the same bank.
It could be not necessarily the same bank account, not necessarily.
So I have two.
Okay.
One I can use for traveling, and I'm not
Yes.
charging over, whereas the other one, if I use it in Montreal, I'll be supercharged on the interest, on the exchange rate.
Some is zero
So that's-
fees if you travel, so you use them. Some give you insurance on the car. Some give you like a lot of points and benefits if you buy on Amazon. Some gives you a lot of benefits if you buy somewhere else.
Or you get a month.
Like there are, I'm not the one, but there are people who really like maximizing that. And one of my co-authors is doing that.
Maybe it's too early to discuss this now, but it looks, from this kind of related to the degree of sophistication of the.
Yeah, we'll get to that.
And this is the variation you are using, so
Yeah.
it could be.
We'll get to that exactly. Yes.
I've got a MasterCard because I need something I can use in Europe more than others, and I never use it in the US. Don't call me
Are
unsophisticated.
you sophisticated consumer?
I'm going to insist on.
So these are the data without sort of any manipulation. This is just plotting the data. So we are plotting our net rewards variable across the credit score distribution for the rewards card, the solid line for classic card, the dashed line. By construction, clearly net rewards on non-reward card cannot be positive. At best, they approximate zero for these very high FICO guys, which are at very low fees. Yes.
What is this minus 20? Is that basis points?
No, yes, exactly. So for these guys here, instead, there is positive and negative rewards. These are dollar. These are monthly net rewards that you have on a card. So this guy here, for instance, is basically the guy with, on average, with a 720 credit score on a reward card pay negative net rewards of about $25 per month. So that's how much they pay using a reward card, how much it costs to them. These guys over here are the guys who are actually benefiting on net terms from using reward cards. Okay?
So basically, the benefits are like the reward dollars that you are getting on the card, and you factor in APR by calculating through the balance.
Yes. Yeah. So from here, it's purely descriptive. You can say much, but there's a bunch of intuition here that clearly you see there is a lot of redistribution across different people, and there is like different behavior also like across cars. So for instance, if you think about here, low FICO people would be better off to some extent having like a classic card because it would pay less. Clearly, better off is a sort of not correct as a statement because people can have like incentive they want to be here for some reason. For instance, we control for that reward credit card generate larger credit limits. So maybe it's just a sort of a willingness to pay to have like access to credit. So we don't. That's why we do the regression. But the intuition at least is that for some people it would be better off to have a classic card than a reward card. Yes.
So the net rewards have three components, two of which are variable. One is a variable benefit, one is a variable cost, and there's a fixed cost. Do you have a sense of, is this just picking up more usage by people who have then a higher credit score?
Yeah, we'll come to that. We will show exactly, especially when we look at the bank perspective, we see where the source of income come from. And so for some people, clearly, there is a lot of sort of costs coming from being a revolver, and so paying a lot of interest on outstanding balances. I can tell you from now that, for instance, the fixed cost fees is basically irrelevant.
Okay, so
It's irrelevant for everybody. It's very small. So the whole story is about interest payment on unpaid balances. So it's like being a revolver and over borrowing.
last thing, sorry, the total costs, are the majority of these zero, or do you see variation in that too?
No, there is variation.
There's, okay.
So this is all descriptive. We do a regression. This is the question I showed you before. Different set of fixed effects. So basically, if you have a reward card, on average you have higher net rewards. What is interesting is here, it's a sort of a split across the FICO buckets. So here, when we compare people who are very, very similar, we still find that the subprime and the near prime guys lose money using a reward card compared to a classic card, while the prime and super prime gain. And the dollar amount is pretty big. Like you're talking about $7, $15, $16 per month. So it's more, yes.
Just for clarification, do you control for credit limits?
Yes, we control for credit limit, and in a second I'll show you the robustness in which we do more than that. But yes, we control for, I haven't said, credit limit, amount past due, card age, joint account indicator, fraud, and a bunch of other stuff that we have. But the most important is clearly credit limit.
And those are, sorry, back on that one, just to clarify, and those controls are done additively or with the FICO score or not?
No, this is additively. So this is the set of fixed effect, and then we have card-specific and cardholder and the card-specific
So it's
controls.
possible, for example, the credit card limit might matter more to people with lousy FICO scores than...
Yeah. So this is basically those results over there plotted, like when rather than splitting across 4 income buckets, here you have, I guess, 50 buckets, and so we sort of a continuous distribution, and you see the same shape as before, okay? So these guys are losing money, so this is basically the relative net rewards, it's a coefficient on the interaction, and you can see the people over there instead benefits. To get to your point, here we do exactly that. So here we do 2 exercises. In the first 4 columns, we restrict the sample, not on the bank zip code, income, and FICO fixed effects, but we also have the credit limit and the APR fixed effects. So this is all multiplicative, so clearly the sample becomes much, much smaller. We don't have so many people so much similar. But still, it's nice to see that if you run the same regression as before in that sample, with the all fixed effect, we find similar results, and then we which is basically here. Then we have the new fixed effect, so we look within the same credit limit, within the same APR, and we find, again, it's the same effect, the same distribution. Clearly, I guess, as people would expect, the magnitude becomes smaller because we're comparing very
Very small.
Yeah, much smaller, yes.
These magnitudes are again, we should interpret that as dollars?
Yes, this is dollar. And in the last 2 columns, we do the exercise within borrower. So rather than simply having all this sort of fixed effect, we just have a borrower fixed effect and exploit exactly the fact that he was saying that people have multiple credit cards within the same bank, and again we find similar results, and in this case the magnitude become larger again.
So is that because reward cards have high APR?
No, at low APR, and come back on the second. That's when we look at the bank size. It's exactly why bank make you sort of getting a reward card, offering you a low interest rate. But let's say they make a lot of money because you spend a lot and you pay interest. That's basically I told you the paper already. Yes.
You said something about fixed cost, and I missed it. Would it make sense to scale these? Would they always scale with high fixed costs?
Yeah, we could. I guess to some extent, when we have when we really control for AP, especially the credit limit, then here the fixed costs are already the variation in fixed cost is already there. Like if you have this here you can take into account of the fact that you have very different sort of, especially reward card, like the $500 per year reward card, they give you crazy benefits and so on. And so this is control for when we have these fixed effects. So because basically it's associated with credit limit and it's associated with APR. But we can even do that. We can do that. So let me sort of try to move on. So When we aggregate up so we have this number which is also annualized redistribution about 15 billion. And you can see that there are cardholders with negative net rewards, which pays about 4 billion in a year using a reward card. And the one who gains, so the one with net positive reward, earns about 1.3 billion. Clearly the difference is saved to the bank. And when we split this 4.1 and 1.3, we can see that basically from the one who pay tend to be the subprime and the near prime borrowers. When we look at the one who gain, tend to be the sort of super prime and prime borrowers, cardholders. Then we look at sort of the components. So we can split our net rewards in sort of the rewards, let's say the gross rewards, interest charges, and total fee charges. As I said before, total fees are economically irrelevant, let's say. They're very small and there is very little variation across the FICO distribution. What is interesting is looking at rewards and interest charges. Rewards clearly are increasing in FICO score. So basically, the more you move along the FICO score, then people tend to spend more. But what you notice here is that the interest charges tend to be larger for the low FICO score on reward card compared to classic cards, while this is not the case for prime and super prime guys. So these guys are spending a lot, but actually are repaying their cards, and so they don't have interest charges, while the subprime and the near prime tend to be a revolver and they pay. So this is the first sort of piece of results that would explain our story. So how to interpret that? So for now, I just talk intentionally about low and high FICO guys without putting any label attached to that. So it's kind of weird that it didn't come out so far in the discussion, but generally, people tend to think that this is all about income and it's the poor subsidizing the rich. It's called this reverse Robin Hood effect. It's all over the press. There's a lot of articles that basically say that the poor foot much of the bill for the credit card points, miles, and cash back, and there is legislation now in Congress in the U.S. exactly to sort of limit that, also for these reasons. So what we argue in the paper is this is not the correct way of thinking about that, and how we do that. First of all, there is evidence, and there is a paper by colleagues at the board showing that credit score and income are clearly correlated, but they're not strongly correlated. It's not one-on-one matching. There's a lot of variation between income and FICO score. Second of all, we do our analysis splitting the sample in three different decile of income. So we have low income individual, the middle income, and the high income individual. And you can see from the chart that basically you have the same stories. Clearly the magnitude, the dollar amount of a distribution changes, but we have the same shape if we look at the lower income tercile, the middle income, and the high income tercile. And if you look at this part of the distribution, clearly you see that the high income benefit at the expense of the low income guys. So if you just focus here on the high FICO part of the distribution, then it's really the case it's Robin Hood hypothesis matters. It's the poor who are subsidizing the rich. But if you look at the other part of the distribution here, if anything, here are the high income people who are losing more than the low income people. This is dollar term, you should scale by their income and so on and so forth, but we do that in the paper. Here we do the regression. It's exactly the same story that basically I showed you before. In the paper, we also look at the top 10%, top 5% of the income distribution. It works and goes through again. So what we argue in the paper is a story about financial sophistication. So we think about FICO score that can sort of capture behaviors that are associated with lack of financial sophistication. Again, there is literature, not only by Coder of Mine, but others also arguing that FICO can be taken as a measure of financial sophistication. We don't just take this for granted, we do a couple of additional exercises to sort of substantiate our assumption here. So we do two tests, basically. One test is over-indebtedness. We want to show that the reward card induced overspending by consumers, and therefore some of them will end up with a larger unpaid balances and therefore spend having higher interest rate on these unpaid balances. We do that in a diff settings. And so basically we compare similar consumers with a bank-initiated credit line increases in reward and classic card in the same month. And I'll show you in a second. And the second of all, we look at suboptimal repayments. And we want to see misallocated repayments on different credit cards are larger for reward card than for classic cards. And this is especially the case for low FICO individual versus high FICO individual. So first of all is over-indebtedness. So here we exploit 1 year of data. So we look at card holders which receive the bank-initiated increase in the credit line. So it's basically what you get in the mail, and that tells you, oh yes, your Chase card, your credit limit goes up by $300, $2,000, whatever. Okay? So this is basically usually from the bank, is not asked by you. Somewhat supply driven. And we do that for classic and reward card that receive this credit limit increase in 2019. And we compare the change in spending, payment, and unpaid balances 6 months after and 6 months before March 2019. Clearly the sample is not that big, but still we have more than 1 million cards. What you see here, that you can see that reward card induce spending more. That's what people know. You know, when you get credit cards, you tend to spend for a number of reasons. First of all, you want rewards. And this is true across the entire FICO distribution, and clearly the high FICO people spend more with a reward card than low FICO people. Then you can see that in column 3, payment, which is how much you repay your card, also increases of reward card more than the classic card, but less than proportionally. And as a result, in column 5, unpaid balances increase as well. So people become, on average, more likely to be revolving. Okay, the cost. What is interesting, again, is when you split across the FICO distribution, because you can see that all of them spend, but only the prime and the super prime can actually are able to pay back their cards. These guys are not able to pay back anything. So it's not surprising to show that in the end, the subprime and the near prime end with like larger unpaid balances on the reward card versus classic card after this credit limit increase, while nothing happened for this guy. So this guy only take the benefit of that. So there's a credit limit increase, they spend like crazy, they repay, they get the rewards. This guy, again, you know, we don't go into that, but you know, one simple explanation could be they're overconfident about their capacity to repay. They spend like crazy, they don't repay, and they bear the costs.
Am I right in interpreting your explanation as like a causal interpretation?
Yeah, here yes.
Because we don't have a setting where like reward cards are randomized, right?
No.
So like in a sense, like there's a lot of other reasons. Like a reward card is an additional credit card, so if you're credit constrained anyways, maybe it was easier to obtain the credit card, and so you have additional credit.
Yes, no, I totally agree. And this is like a key limitation we have.
There's a lot of other causal things of having an additional credit card.
Yeah, no, I agree. This is the closest we can do with the data we have to get sort of to a causal statement in which we compare exactly the sort of increasing credit limit. So it's not that you have a new car. So you just have like an expansion in your credit limit. So the experiment that we have is you already have your card. I have a reward card, you have a classic card. The same month we get $2,000 more, the two of us. And then we see that I with the reward card spend more than you with the classic card, and then we should add additional people like different FICO scores, and that's what we observe.
So I'm sorry, you're comparing before and after the increase?
Yeah.
And the increase is for everybody?
Yeah, the one, yes.
But you're...
Yeah, because we are looking only at, in fact, 1 million and 1.2 million cards. So these are only, in our sample of 200 and whatever million cards, we look at this only at the cards which have the credit limit increase in that month.
Right.
And then we look at the 6 months spending before and 6 months spending after and before.
But did you look at parallel trends?
Yes.
And across the groups?
Yes, yeah, and we control for that, so I should have said it. But we control for that, we look at it in the pre-period, and spending and payment, and so on, yes. And pre-trend as well.
Well, one thing is to control, the other one is to hide.
Yes. No.
It's different.
No, I know it's different, but we do that.
Okay.
It's tricky because clearly it's, the way the bank do that, it's clearly not as you should say, not random.
Yeah, so I would expect that there's, a higher, I get a bump in how much I can spend if they know I'm going to be paying, and that's going to be correlated with my prime, my score.
Yeah, no, I agree. But with this set of controls, we have parallel trends. Unconditionally, we don't have parallel trends.
But even with parallel trends, the effect can be just mechanistic, right? Because I've got classic card and the reward card, and I'll just spend more on the reward card because I have a higher limit, so I'll spend less on my classic card.
But here is the limit. You have a delta on the two. The limit is the same. So first of all, I don't know if we have them. We control for. They should be there. For sure, we control for the credit limit. So we're comparing cards with the same credit limit. But then the experiment is the delta on the two cards.
Yeah,
So let me. Yeah.
question you have 9.
Yeah. Let me move on.
What's the question?
So what makes the effect on unpaid balances not to be the difference between the effects on spending and payments? I would say 75 minus 31 should be the effect.
Oh yeah, it's not one-to-one matching arithmetically.
Yeah.
Yeah.
Like what?
I don't think it should, but
Interest rates? The interest you pay?
yeah, I don't know. These are averages within
doesn't
these
happen.
branches, so there will be a lot of.
Especially with all the fixed effects.
Yes, and they shouldn't like be algebraically the same. So let me move like a couple of other things. One is also the misallocated repayment. So misallocated repayment is, we have different cards. There is an optimal rule in which you can repay the card. It's basically the minimum payment to all the cards. Then you pay the most expensive and you go down the line up to the cheapest one. No? So we can compute. So here it's nice because we really look at financial mistakes. We know the optimal rule of repayment. We can observe the actual repayment of the credit card, and so we can see the share of misallocated repayment. First of all, we can see that misallocated repayment are associated with the credit score. So this again suggesting that there is a sort of a. We can interpret FICO score as a measure of financial sophistication because this is a sort of a good measure of financial mistakes. Then we want to show that this misallocated repayment tend to be more common in a reward credit card, and especially for subprime and near prime individuals. That's exactly what we find here. We condition on different samples, making sort of the sample more and more restrictive. But again, you can see that misallocated repayment are more common on reward card, but these mistakes are only present in the subprime and the near prime guys, while the prime and the super prime guys don't make financial mistakes, and that's why then we can interpret like naive or less sophisticated guys and more sophisticated guys, the subprime and the super prime person. Then we keep on looking at, we do a further exercise, and we know like there is this nice paper by Gathergood and Cotters, and they are showing that basically when you repay credit cards, you can follow a lot of different heuristics. What they find is generally people tend to follow a balance matching heuristic. So you repay your credit card in proportion how big is the outstanding balance. Somewhat you're sort of scared by this outstanding $5,000 bill on your card. Okay. So what we can do here, we simply look at by the four FICO buckets. We look at the actual repayment. You can see the optimal repayment that people should do, and this balance matching heuristic, which has been shown to be the most common way of repaying cards. And if you look again at subprime and near prime people, you can see that the actual share of repayment, which is the sort of white column, is very, very similar to the balance matching heuristic, so the sort of financial mistakes that people make repaying the cards. If on the other hand you focus on prime and super prime individual, you can see that the actual share of repayment is much more similar to the optimal one. So again, this is again in evidence suggesting that this prime and super prime individual tend to behave optimally, while the subprime and near prime individual tend to behave suboptimally. So let's look at the bank perspective. So we look at bank profits. Bank profit is it's interest paid plus total fees plus interchange income, which is the big chunk of how much money banks make using credit cards. So it's basically minus the rewards and realized charges. So the key part here is interchange income, which is basically a function of purchase volume, and it clearly varies across cards. So what we do here, we do a lot of robustness, but we apply 1.5% for classic cards and 2.5% on reward cards. Generally, reward card, merchants are charged much higher merchant fees when you pay with your Amazon card or Chase Sapphire card, whatever, and they are charged much lower merchant fees when you buy with the non-reward cards. That's why some merchants don't want you to pay with a reward card. This is exactly why there is legislation now. Legislation now in Congress is basically to lower these interchange fees, which basically will kill the whole market of rewards in the system.
So sorry, the interchange income is what the merchant pays. It's not the interest rate that.
Yeah.
Okay.
Yeah.
Yeah.
But this is then it's more complicated. Some part go, but most of that goes to the bank.
Okay.
Let me skip for the sake of time. And here the two things. First of all, came out in the question. APR is clearly declining in FICO scores, but it's much lower for reward than for classic cards. And that's why we think that would suggest that banks use the APR to sort of induce you to get a reward card. And if you look at profits, this again, pure data without any manipulation. Profits, bank profits through the entire distribution of the FICO score, profit much more for the reward card, especially in the middle of distribution. And these are the guys, they spend a lot and they cannot repay. These are sort of the revolver. But they profit clearly also for these people here who spend so much, and so they have a lot of interchanging. And we do the same thing in a regression setting, same exact results. Let me skip that. And if you look at the sort of source of income from the bank, you can see that at the lower part here is interest income. The more you move on the high FICO people, it's basically interchange. So people spend a lot of money. And there is not much of a difference here from reward card and classic cards. Fees income is kind of irrelevant in economic terms, and there is not much. I think I'm almost done. The final thing is in the spatial disparities. It's a very simple exercise in which we aggregate everything up that we have estimated, and we want to see this redistribution across people with different FICO score can contribute to existing spatial inequalities in the US. So this is the geography of net rewards, where the darker is like higher rewards and the lighter is lower rewards. And it's, I would say, the standard US chart you can overimpose to any other possible demographic in the US. You have the cost, and in part of the US they gain the most. If you do the same for FICO score, it's very, very similar. So again, this suggests, at least in a very sort of naive way, that this measured FICO or financial sophistication clearly matters for net rewards.
I like the use of a legend to high Florida. So keep going.
Actually, no, in the paper they fix it, but in the slide. So we do, here we do a super simple exercise. At the card level, we have the net rewards as a function of some characteristic of the zip code and the average or median, I don't remember, nothing changes, of the credit score within the zip code. And so we look at education, income, and the share of black population. You can find different sort of proxies for the same stuff. And if you don't control for the credit score, so if you don't control for financial sophistication, you have evidence that there is distribution from less to more educated, from lower to higher income areas, and from area with a high share of black population to area with a low share of black population. The moment you control for credit score, all this correlation goes away. So again, we're saying that clearly, in a descriptive way, there is this sort of bigger distribution, which is can work also from rural to urban, across different dimensions, but this again is all driven by the fact that there are different sort of borrowers with different degree of financial sophistication in those areas. And so this is all driven by sophistication. So let me conclude. So what we do, we show that sophisticated individual profits from reward credit cards at the expense of naive ones. Our results are not driven by income, so the income story could clearly explain part of the story, but it's not exhaustive. But they are explained, are driven by financial sophistication. We show that the reward credit card actually induce overspending, causing naive consumers to have higher unpaid balances. Also, naive consumers have higher misallocated repayment on the reward credit card and follow generate costly balance matching heuristic while repaying the cards. On the bank perspective, banks sort of attract consumers offering lower APR on a reward card. And banks also profit across the entire FICO distribution. And finally, we show the reward card transfer income from less to more educated, poorer to richer, and high to low majority areas. And with that, done. Almost on time. Thank you.
Hey everybody.
And he has access to these data too.
Yeah, so I work with these data too, and I enjoy it, and I want to say I honor the pain that I know it takes to get to this analysis, because I've suffered it myself too. So thanks so much for the opportunity to discuss this cool paper. I will very briefly recap some of the key findings, but honestly I thought there was a great description of those, and so I won't belabor that. The main focus of what I'm going to do today is talk about framing and implications. Okay, so we've got detailed data on cards and how they're used, with an eye towards understanding rewards and how rewards cards get used, and how that use varies with card type, like classic versus rewards cards, and the interaction of that with FICO scores, so the experience of high FICO guys and low FICO guys. So there's just this tremendous wealth of stylized facts. I think you did a great job of highlighting those, and I think they're extraordinarily useful. So we see average use, we saw the marginal propensity to spend out of limit increases. I would say thematically, if I were to describe your main thematic interpretation, it's the higher FICO folks, they benefit the most from the rewards cards, and the lower FICO folks don't benefit or have a negative benefit. Rewards cards induce low FICO consumers to overborrow, is the language that you use. Okay, so this is all presented through lenses that you might call cross-subsidy, transfer, or redistribution. So those are words that you use. And I'm going to propose an alternative framing of a lot of these same ideas. But what I want to say is, from my perspective, the paper is sort of equally cool, and what I'm really loving is the facts that you brought out here. And I'll present a little different way to think about them, which I think is going to give you some places you can poke to go more. But I think with some sort of specific quibbles about like the difference in difference stuff that we've heard about from the audience so far, we've got some stylized facts that are really good to work with, kind of regardless of how you want to interpret them. Okay, so I'm a professor in a department called Risk Management and Insurance. So let me talk about cross-subsidies through an insurance lens. This is sort of classic, and then we'll talk about the deviation here. So typically in insurance, we think about cross-subsidy working as follows. We've got high-risk people, like bad drivers. We have good-risk people, like good drivers. They're all buying car insurance. They're buying a common product at a common rate because they're unobservably identical, or they're observably identical and unobservably different, so they're buying this common product. In some sense, the high-risk guys are underpaying for insurance and subsidizing or being subsidized by the low-risk guys who are overpaying given their risk. So that's the traditional thing, and that leads to adverse selection, right? Because the low-risk guys are getting a bad deal, they're providing the cross-subsidy, they have an incentive to go out and seek another product, and insurers want to offer them a product to do cream skimming, to pull away those profitable subsidizing customers. That typically happens with cheap partial coverage. So that's a cream skimming product to lure away those more profitable customers at the expense of the less profitable customers. Okay, so that's like an insurance traditional example. And then in this paper, we're seeing a sort of similar idea play out in credit cards, and there's an existing literature sort of about settings where it may not work quite like this. So in particular, we've got this idea that there's somebody called unsophisticated, and this unsophistication could be important and interesting because being unsophisticated limits the scope to act in the way that we normally try to pull away the subsidizers from the subsidized, which is, if you're unsophisticated, you may not know you're providing a subsidy. And so this whole, like, let's offer a product to cater to these guys to pull them away won't work because they don't know they're being screwed over, basically, right? So that's this classic literature, and I think you're providing a great example in the form of rewards cards, right? They're these low FICO guys. They're imagining that they're going to use lots of rewards. They're like, oh, this is a great card for me. It's not really, but they think it is. And you can't really design a product to lure them away very easily because they don't know they're being taken advantage of. Okay, so we kind of think that rewards makes a lot of sense because this is a setting where some people play these games and are very sophisticated about them. Other people just buy the card, may not have a lot of sophistication. And we're thinking of FICO here as being kind of a cool proxy for unsophistication. Okay, so let me provide kind of a broader framing for credit cards as an application where this plays out. let me mention 4 key features that a credit card might have that might influence whether you use or whether you choose a specific card. So cards have annual fees, right? Like a fixed number, everyone knows it. Nobody likes paying money. That should deter everyone. And I would say even the most unsophisticated people see that they're paying an annual fee. So presumably that's one where sophistication isn't really in play. And it's also symmetric. Kind of everybody pays the fee. Then we have interest rates. That's another dimension in which cards vary. Nobody likes to pay an interest rate, but personally I could care less what my interest rate is because I don't carry a revolving balance. So it's relevant for people who carry a revolving balance. And sophistication is important because if you have a wrong idea of the revolving balance you're going to carry, you might wrongly take this into account, right? So that's the sense in which sophistication might switch this compared to some optimal benchmark where everyone understands what's going on. A third dimension is rewards, right? So I value rewards as somebody who spends a lot on a credit card, but in a world with unsophistication, having rewards is appealing not just for people who use the card a lot to get a lot of rewards, but for people who imagine they might get a lot of rewards even if they don't actually, right? So unsophistication could be important in inducing folks who maybe won't use the card a lot, but they think they will. They'll want those rewards. And then finally, I want to say marketing is a big deal. We all get mailers constantly. We all get offers. Banks spend a huge amount of time trying to attract us. Now, in theory, that doesn't help or matter. We should ignore that if it doesn't contain useful information. But one way in which I think clearly, first of all, that might affect a lot of us, but certainly one dimension of unsophistication is you might expect less sophisticated people to be more swayed by the advertising. So let's think of a card as being a bundle of these 4 attributes, and we're really thinking then about how might unsophistication connect with how people choose among cards that have these 4 attributes. Okay, the key thing I want to say is that card issuers may try to use these attributes to exploit unsophisticated people, and we may want to think about how that might work out. In particular, you might use marketing to convince the unsophisticated folks to buy your profitable card. You might offer cards that are profitable to the issuer but otherwise undesirable that have rewards to try to get these unsophisticated folks to sign up. And you're going to try to attract unsophisticated people who wrongly anticipate large rewards because they wrongly anticipate they're going to spend a lot. And so you have rewards, you advertise to the unsophisticated people, hey, take the high rewards card. You imagine you're going to use it a lot, so you imagine it'll be good for you. That's how you attract those people, and you end up making money on them when they don't actually use the card that much. Okay, so in equilibrium, we have a cross-subsidy where issuers compete for the business of otherwise identical folks, including the sophisticated and the unsophisticated, right? And we're going to try to be attracting sophisticated people with heavy transactional use, but also unsophisticated people who wrongly anticipate they will have heavy transactional use. And you'll see a cross-subsidy, where the sophisticated guys who use it a lot, they get all those rewards. The unsophisticated guys who think they're going to use it a lot but don't, they don't get the rewards, we see a cross-subsidy, right? So that's the way you've been talking about it. Competition is going to drive profits to zero. And keep in mind, by the way, that what you observe is the profits on the card conditional on having the card, but since you don't see the marketing or you're not looking at the marketing expenses will adjust in equilibrium so that, on group by group, the profits will be zero. Okay, the prediction here is that sophisticated people will outperform unsophisticated people in a common market, which is exactly what you see in your data, and you showed us that very nicely. Okay. I want to talk about observability. In the initial example I talked about with car insurance, the key thing was we had good drivers and bad drivers who were observationally identical. The insurer can't tell who's who. As a result, they're playing in a common market where a cross-subsidy is possible. The key thing to note is that if you can target the sophisticated and unsophisticated separately with different products, then we're not going to get a cross-subsidy. We're going to get separate competition in the 2 groups separately. So the question is, is sophistication, or whatever proxy you're using for it, an unobservable or an observable attribute? And how would it matter if it were observable? Well, if it's observable, you design one product for the sophisticated, you design another product for the unsophisticated, and we're going to see competitive markets in the two products separately. So the thing I want to flag here is that FICO is, and furthermore, use history, like are you a frequent user historically, these are observable features of your data, and we should expect separate competitive markets for high FICO guys and low FICO guys. There can't be cross-subsidies, there can't be redistribution, there can't be transfers, because we have competitive markets that are operating separately in these different buckets, absent a regulatory concern like I am required by law to offer all guys the same rates regardless of FICO. But like clearly that's not true, right? Clearly good and bad FICO guys get different rates. And by the way, even if they got the same rates, which they don't, you can still have differential competition in the marketing. So you offer them the same rates, but then you notice one group is more profitable than the other, so you load up on the marketing on the more profitable one, not on the unprofitable one. Okay, so there's really no obstacle to differential targeting, so we would expect separate competitive markets for these different groups. Okay. The key thing, though, I want to flag is that with observability, with these separate markets for the sophisticated and the unsophisticated, for the high FICO and the low FICO, you get a lot of the same predictions. Because you take the high FICO guys, who on average are more sophisticated, in that group, you compete to offer valuable rewards, right? You're going to make money on those folks, but since they value the rewards you're giving them, the dimension of competition is offering them good deals, right? So you should expect those guys to get good deals on average, because that's how they're choosing their cards. They're choosing cards that give them good deals. So the dimension of competition is going to be give them as many good deals as possible. The unsophisticated guys don't understand the quality of the deals that they're getting, so the natural dimension of competition I would expect would be along marketing. You know, once you have this guy, he's hugely profitable because he doesn't understand what he's bought. So it's a hugely profitable customer, you're going to load up on marketing. Spend a lot of money on CAC, customer acquisition costs, because conditional on getting him, he's very, very profitable. So we have the same empirical prediction, which is that the high FICO sophisticated guys seem to get a good deal, the low FICO unsophisticated guys seem to get a bad deal, but there's no cross-subsidy, there's just competition in two different markets acting where the competition is in different margins. Okay, so what I want to say is you presented stylized facts, they're amazing, they could mean a couple of different things. I have a guess about which one it is, but either way, your stylized facts are awesome. And then the question is, how might we be able to differentiate those? And the answer is there are data sets, for example, like Mintel, which has data on credit card offers. And you could ask the question, do we see a lot of targeting of rewards cards to low FICO guys compared to high FICO guys? Like, is that ratio different? So like, that's a prediction of my model or my framing that's different than your original framing. You could test that out, right? So, I mean, either way, your empirical findings, your stylized facts are like amazing. And then the question is like, what's the right sort of competitive model that that frames those? Okay. Yep. And I've said everything I want to say. Amazing paper, great stylized facts. I'm pitching an alternative explanation of the same facts, but I think the paper is kind of equally cool regardless of what you think the framing is. So thanks a lot.
Thanks.
No, I think I just want to say that I agree. I think that's a good point. Being back and forth about how to interpret that. I think we don't want to use the word cross-subsidization in our setting, but I don't think we do that. But we talk about redistribution. I think your framing makes sense. We can test. We thought about Mintel. We thought of two different ideas. We want to do sort of to get identification of this sort of offer because, you know, but then there is not enough spatial variation, but maybe we can do that. But overall, I think it's a good comment.
And I think the point, and I think the point that Stephen's making would also bring up the racial and gender discrimination literature, because it's exactly, you could have been channeling Gary Becker in terms of, you know, decades ago. So there's it's a very super rich area. Any questions? Yes.
Yeah, I have a question. In one of your last slides, you control for credit score, and then the socio-demographic characteristics of the zip code goes away, or the association. So when FICOs are calculated, don't they take in consideration the zip code that you're in?
Yeah, I think so, yeah.
And if they do, why? I mean, is it because they're looking at the share? No, but
Yeah.
right. I mean, so in some
Sure.
ways, if the FICO is calculated using the share of poor people, the share of African Americans, etc., that table is kind of misleading because you're controlling for, you know.
Yeah, I see your point.
Yeah.
You've also scratched the belly of some ongoing litigation with respect to what is effectively statistical redlining, particularly when companies use machine learning models, that shiny toy about business schools. But that's I'll not say anything more about that.
Yeah. No, it's true, but we wanted to go in that direction of this redlining, but then there are two quarters at the board, so we don't know how much we can go that far.
But that's a great. I think it's a great.
Yeah, just 2 quick points. You said that the FICO score measures financial sophistication mostly, but it seems like it could get at wealth versus income. Like maybe you're not paying your credit card because you have other debt or you need to help family or other things. So that's one. And the second one is, I thought like a lot of these cards, like the airline linked ones and whatever, like I thought one of the ways that they make money is by selling your data. Then I also assumed I'm exchanging data for rewards. So money is fungible, so I was kind of wondering how you're thinking about that form of subsidy or other things that are not quite in the model.
No, both good points. Like on the second, I don't have a great answer. On the first, we thought a little bit more. Not a blackout. What was the first?
Income versus wealth.
Oh, income versus wealth. No, yeah, it's true. There could be a bunch of things happening. So, for instance, I guess people generally are worried about the fact that we have this sort of high-income people with low FICO score or the other way around.
Yeah.
So what we can do, we haven't done, is, for instance, you can see like, sometimes like FICO just dropped because you had like a medical emergency or something like that. So what we can do, we can drop at least those and look at people that like in the past year had a somewhat flat FICO, and so that probably goes at your point. On your second, it's a good point. I honestly don't have a good answer, but it's...
Just on the second, if I may, there's rich literature. It's a US version of the famous portfolios of the poor in developing countries, but it's done in urban Atlanta. And I often find, for example, that people who might be then labeled as unsophisticated are either black entrepreneurs who are using their lack of access to funding in order to fund small growth in entrepreneurship, or far more significantly, vulnerable populations of single household women who are the sole household that are still trying to catch a job. But so there's a deepness to what is going on there in terms of other factors. If I could just leave that there. Somebody had a final question.
I was just wondering how you think about kind of the effect on prices, like that people kind of go to the store, they pay with a rewards card, like are they is the business either passing that on, and can they pass on kind of a different percentage for the reward card holder versus the...
That's a great point. I think that's what we wanted to start. So the original idea was to do something like that. This is more like on cash versus card and the sort of the pass-through to prices. So basically what we are doing, and this Robin Hood story was card versus cash. We're doing within credit card, reward versus classic. And in theory, you should have some sort of pass-through to price. The point is that we really don't know how to observe prices so granular, so low level. Like either you have this sort of the Cavallo kind of data, like on, but it's very difficult to get. As far as I know, they're not there.
I was thinking there could be some interesting like redistribution from from the normal card holders to the reward card holders, because essentially the fees, they're paying the same price for the good, but...
No, I totally agree. If we just had some sort of zip code, merchant, level data on prices, on something that would help. But so far we don't have those. In theory, like if you have like, I don't know, like big retailer, like, Whole Foods or Amazon, Safeway, and having like different kind of pricing, even in a few areas of the US across zip code, you can see if there is some sort of pass-through, because Whole Foods discriminate across zip code in terms of pricing. So, but we don't have those data.
And there's also elements of very sophisticated price discrimination going on there, because they're learning something about the people that come on in. So very often you have partnerships where the information is flowing both ways. It's a bit like coupons, but through a credit card. So.
Yes.
Any final questions? Okay, thank you. We had a fabulous session. One thing.